Shri Gurubhyo Namaha children. We are in Unit 9 Ratio Analysis, and today we are going to discuss about turnover ratios. Right? In the previous class we've been discussing about liquidity ratios, which included current ratio and quick ratio. So they are short-term solvency ratios. Today we are going to discuss about turnover ratios. Right? So these turnover ratios, they show how efficiently your asset, if you're using a machinery or a plant in a factory, how efficiently your asset has been used to generate the revenue from operations. So the another name for turnover ratio is activity ratio or efficiency ratio. They show the speed of movement of the various items, the speed of movement of various items, and they're expressed in number of times. Unlike liquid ratio, where you're going to express it pure in quotient, right? Now this ratio is going to be expressed in times. So we're going to discuss about four important turnover ratios, which is inventory turnover ratio, in other words, stock turnover ratio, trade receivable ratio, which is called as bills receivable ratio, trade payable ratio, which is called as bills payable ratio, fixed assets turnover ratio. Right. Inventory turnover ratio. What do you mean by inventory turnover ratio? Now, inventory turnover ratio, first of all, indicates the number of time the inventory is turned over to make revenue from operations. Now, what do you mean by revenue from operation is nothing but sales, right? During a particular accounting period. Now, accounting period may be from January to December or from March to April. It's a comparison of cost of revenue from operations. Cost of revenue from operations is nothing but cost of goods sold. The average amount of inventory during the given period. Average is calculated by opening inventory plus closing inventory divided by 2. That is your average inventory. Fine. Now you have a formula here, inventory turnover ratio. How to calculate inventory turnover ratio? So inventory is calculated with cost of revenue from operations, which is nothing but cost of goods sold. Okay, cost of goods sold divided by average inventory. Now, cost of revenue from operation. How to calculate cost of revenue from operations? So that is purchase of stock in trade plus change in inventories of finished goods plus direct expenses. Now I explain to you how to calculate changes in inventory. Fine. Now cost of revenue from operations is equal to purchase of stock in trade. That is purchase. Now how do you calculate changes in inventories? So changes in inventories. Changes in inventories is nothing but opening inventory minus closing inventory. Fine. So this is change in inventories. Now what are direct expenses? Now direct expenses are those expenses which are incurred in the factory while you convert the raw materials into finished goods. So what are the expenses? Direct expenses which you are incurring in the factory, which will be coming in your trading account, right? Before that is when you calculate your gross profit. Okay, with that, so all these direct expenses are like wages, okay, wages, carriage inwards, okay, carriage inwards, freight inwards, freight inwards. Then you have coal, gas, then fuel, okay, power, and other direct expenses normally that you're incurring in your factory. Now, how to calculate average inventory? Average inventory. That is nothing but opening inventory plus closing inventory divided by 2. That is your average inventory. So I explained to you how to calculate cost of revenue from operations. So cost of revenue from operation is nothing but purchase of stock in trade. Okay, whatever purchase you're doing. Then change in inventories, which is nothing but opening inventory minus closing inventory. And what are direct expenses? Direct expenses is nothing but all the expenses which you are incurred in the factory or the plant. Okay, that those expenses which are incurred in converting the raw materials into finished goods. Fine. So average inventory is opening inventory plus closing inventory divided by 2. Now let us go to the first problem. Okay, before that, so in the absence of the opening inventory, closing inventory can be taken instead of average inventory. Now, in case in a problem, they've given you opening inventory or they've not given you opening inventory, they've given you closing inventory. So how will you find out the average inventory? You take closing inventory. Okay, so you can take closing inventory in the absence of opening inventory. Now, after you calculate inventory turnover ratio, you have to calculate the inventory conversion period. Now, how to calculate inventory conversion period? Inventory conversion period. What is inventory conversion period, first of all? Now, inventory conversion period is the time taken to sell the inventory. So, whatever you manufactured, whatever product you have manufactured. Okay. What is the time taken to sell that particular product? So, a shorter inventory conversion period indicates more efficiency in management of the inventory. Now, for example, you are making scooters or you are into making cars. Okay. Now, how many days you take to sell your car? How many days you take to sell your two-wheeler? Or in case you are like you are into biscuit factory, how many biscuits you sell, and then what time, well, the time duration you take to sell your product that you are manufacturing in the factory, right? Now, let us go to the illustration. So you'll see this inventory conversion period, you can calculate it number according to the problem. Sometimes you may have to calculate it with number of days, or sometimes you will have to calculate it with months. Now it depends upon the problem. In the problem, if they're going to ask you calculate the inventory conversion period in days, then you have to use this formula. Number of days in a year divided by inventory turnover ratio. If it is in months, the number of months in a year divided by inventory turnover ratio. Okay. So you have to be very familiar with the formulas. First, you should become familiar with the formulas. Then it is easy for you to calculate. Right. Now, from the given information, calculate inventory turnover ratio and inventory conversion period in months of Sanya Limited. Fine. And they've given you some particulars. What are the particulars? Revenue from operations, they've given you. Inventory at the beginning of the year, they've given you. Inventory at the end of the year. Purchase made during the year, and then carriage inwards. Fine. Now, shall we go and calculate? Okay, now let us write inventory turnover ratio. Inventory turnover ratio. Okay, inventory turnover ratio. This is actually GURN. Okay. So what is the formula? It is cost of revenue from operations divided by average inventory. Now how to calculate cost of revenue from operation? Cost of revenue from operation is equal to what? Your purchase first. Purchase made. Okay, purchase plus change in inventory. What is your change in inventory? Plus change in inventory. Then plus direct expenses. Right? Direct expense. So let us find out what is the purchase. Purchase is what? Here you have your purchase 90,000 rupees, 90,000 plus what is the change in inventory? Change in inventory is opening minus closing. Right? So here you have your opening inventory minus closing inventory. So opening is what? 40,000 minus 20,000. Okay, and then plus direct expenses. What are your direct expenses here? Carriage inwards is your direct expense. So plus carriage inwards, that is 10,000 divided by average inventory. Now how to calculate your average inventory? Average inventory is nothing but opening plus closing divided by 2. So opening inventory is 40,000 plus 20,000, okay, divided by 2. So which is equal to 90,000 plus 10,000 plus 10,000 divided by, here you are having 20,000 plus 40,000. So 60,000 divided by 2 is 30,000. Right? So now you have 1 lakh 90 plus 10 1, and then you have 1 lakh and 20,000. So here you have 40,000. So what is your revenue from operations? You are having a revenue from operation which is 90,000. 90,000 plus 40,000. 40 minus 20 is actually 20,000 here. Okay, so actually this is actually 20,000. 40 minus 20 is 20,000 plus 10,000, right? So you have rupees 1 lakh and 20,000 divided by 30,000. Right, so 4 zeros get cancelled here. Then 3 will go here once, 3 will go here 4 times. So which is equal to 4 times. Right. So this is your inventory turnover ratio. This is your inventory turnover ratio. So inventory turnover ratio is turnover to make your revenue. How many times your inventory is turning over to make, okay, profit. Now let us find out inventory conversion period. So inventory conversion period. Inventory conversion period. So in the problem they've asked you to find out the conversion period in months. So inventory conversion period. So what is the formula for that? How do you calculate? Number of months in a year divided by inventory turnover ratio. This is equal to what? Number of months is what? 12. And how much did you find out? Inventory turnover ratio is 4. So that is equal to 3 months. So that means within 3 months you are able to sell your product. Fine. From the date of manufacturing, you are able to sell your product within 3 months. Right? I hope you understood this, children. Now we will go to our exercise problem. Fine. Now exercise problem, you have here exercise problem number 8. Okay, your exercise problem number 8. Just read the problem. Okay, from the given information, calculate inventory turnover ratio and inventory conversion period. Fine. Now, what is your inventory conversion period in months? You're supposed to calculate it in months of Devi Limited. So they've given you revenue from operations, and they've given you inventory at the beginning of the year, inventory at the end of the year, and purchase during the year. And then they've given you carriage inwards as well. Now let us find out, you're supposed to calculate inventory turnover ratio. So inventory turnover ratio. So what's the formula for inventory turnover ratio? Cost of revenue from operations operations divided by average inventory. Fine. Now let us calculate cost of revenue. Cost of revenue is very easy. How to calculate cost of revenue? Cost of revenue, how to calculate? Purchase plus change in inventory. Purchase during year plus change in inventory plus direct expense divided by average inventory. Okay, average inventory. Okay. Now let us go proceed with the problem. Now you have all the details required here. What is your purchase? See here, your purchase is what? 6,90,000. Okay. So let us see cost of revenue from operations. Now you have your purchase. What is your purchase? 6 lakhs rupees, 6,90,000. Okay. Then plus you have a change of inventory. What is the change in inventory? So here opening minus closing. Right. So opening minus closing. How much is your opening? 1,70,000 minus 1,30,000. Fine. Plus you have your direct expenses. What are your direct expenses? Carriage inwards is your direct expenses. That comes to 20,000. Fine. Divided by. So divided by 1,70,000 plus 1,30,000 divided by 2. Fine. So that comes to, what is the total? 6,90,000 plus you have difference 40,000. So 6,90,000. So let us do it here down. Let us go further down. Now that you have all the details, 6,90,000 plus 40,000 plus 20,000 divided by 1,30,000. 3 lakh divided by 2, 1,50,000. Fine. So now you total the 6,90,000 plus 60,000. 6,90,000 plus 60,000. So that comes to 7,50,000. 7,50,000 divided by 1,50,000. So numerator denominator cancel. 15 over here once, 15 over here 5 times. So your inventory turnover ratio is 5 times. Now how do you calculate inventory conversion period? Inventory conversion period. So that is equal to how much? So number of months in year. So number of months in years divided by inventory turnover ratio. So 5. So actually number of months is 12, right? Divided by 5. So 12 divided by 5. 5 goes here 10 times. 10, sorry, 2, 5 twos are 10. So 2 point goes here 4 times. So 2.4 months. So whatever he is manufacturing, he is able to sell it in 2.4 months. So that's your exercise problem number 8. I hope you understood, children. So time taken to sell the inventory is 2.4 months. Fine. I hope you understood the problem. Thank you.